Oscar Health trades at a discount compared to the traditional managed healthcare sector. Oscar's full year price to sales is only 0.37 compared to the industry average of 0.5. Same for the full quarter price to sales. Oscar trades at a 1.19 discount compared to the 1.67 industry average. But Oscar is growing revenue much faster with an annual year-over-year percent change in revenue of 56% compared to the industry average growth of only 7%. Same for the quarter, 29% compared to 15. Oscar generated $950 million in free cash flow last year with a full year price to free cash flow multiple of 3.5 compared to the industry average of 10.8. This means that investors are willing to pay $3.50 for every dollar in free cash flow Oscar generates, while at the same time, investors are willing to pay $10.80 for every dollar in free cash flow that other healthcare companies generate. The natural next question to ask is, why is Oscar trading cheaper from a price to free cash flow and revenue perspective? Discount is even deeper on a full quarter price to free cash flow perspective, Oscar at 6.7 versus industry average of 43. And finally, Oscar's full year price to book sits at 3.8 while the industry average is at 5.7. So, why might Oscar trade at a discount compared to the legacy industry? Two main points stand out: profitability and potential rise in healthcare costs. From Oscar's quarter 2 earnings report, the net loss amount was $228.4 million or 89 cents in the red of diluted earnings per share. Oscar's Health focuses heavily on the Affordable Care Act exchanges, small employer groups, and Medicare Advantage in select markets. So the potential end to the COVID era premium tax credit for the Affordable Care Act may disrupt Oscar's growth, as some customers may end their health plans because of the potential price hikes in 2026. The potential higher premiums may cause enrollment fallout and lead to a lower growth rate or decline in member count for Oscar. As of now, the enhanced premium tax credit are slated to expire at the end of 2025. If a surprise were to occur and the expiration date is moved farther into the future, we could see a pop in Oscar stock. So, unlike traditional healthcare providers that are majority profitable and reliant on employer plans, Oscar still has some challenges ahead. We cannot ignore the pros about Oscar. There are a tech-first company with a full-stack tech platform. Instead of traditional providers with outdated or vendors, Oscar has Plus Oscar. Their in-house tech stack isn't just a claim system, it's an end-to-end insurance operations platform for enrollment, billing, care management, and analytics plus AI. They can also license this tech out to other payers and providers, something most traditional insurers cannot do. So Oscar can unlock and leverage a new revenue stream. The use of data analytics and AI at Oscar can help predict member needs before members even know that they need them, identify gaps in care, and proactively engage with members. Oscar's digital-first, single market-oriented, and clean underwriting architecture allows it to flexibly move premiums faster, make network adjustments quicker, and respond to regulatory changes with substantially less friction than competitors. That's not a marginal advantage, but rather fundamental strategic moat. And the discount in the stock price reflects these challenges, which can serve as a good entry point for the long term, especially after hearing these pros. Be it only 3 years worth of data, we see quarterly revenue is correlated with the market cap. Annual revenue is also correlated with market cap. Oscar provided 2025 full year guidance revenue of $12 billion. On average, Oscar has traded at a 0.42 price to sales ratio. Assuming this constant multiple, We could see Oscar trade at $20.48 if Oscar generates $12 billion in revenue from the 2025 full year. This $12 billion revenue estimate comes from Oscar's guidance in their most recent 8K. Oscar stock reminds me of SoFi, a disruptor in their respective spaces. SoFi has their own proprietary technologies that they can lease out. SoFi's Galileo provides end to end banking stacks from account setup to card issuing. Like Oscar's plus Oscar, they lease their medical tech stacks, which includes verification, claims processing, and care routing. Oscar is a highly volatile, highly risk, high return play. The current implied volatility is 71 compared to the 20-day historic volatility of 95 and a 252-day historic volatility of 81. Oscar options could appreciate in value if the IV returns back towards the mean. I believe Oscar is a buy in my personal financial journey as a small position. Let me know down in the comments what you think about Oscar stock, and I appreciate you watching till the end. I will see you all in the next one.